In terms of consequences, it's important to understand that first of all, monetary policy, of which the interest rate is one of the instruments, takes time. So there's a transmission mechanism. So even though the CBR rate is under the direct control of the central bank, what happens after that is not under the direct control of the central bank. So this may have an impact on market rates. It could have an impact on asset prices like shares. It could have an impact on the exchange rate. Okay, so raising interest rates is meant to control inflation. Okay, not immediately, but over the next few months. All right, by reducing investment to some degree, okay, increasing the cost of borrowing. In fact, that's likely to be one of the consequences that's likely to evolve over the next few months, that we expect cost of borrowing to go up, okay, because the CBR rate is a signaling rate, and so that's likely to lead to an increase in interest rates charged by banks, all right, which will likely lower investment to some degree, not very substantially, but to some degree, which will remove some inflationary pressure, because part of the inflationary pressure is created by high aggregate demand. So this will tend to lower aggregate demand to some degree. All right, but at the same time, increasing the interest rate also tends to stabilize the exchange rate, because it makes assets denominated in Kenya shillings more attractive to foreigners. Okay, so that should lead to inflows, short-term inflows of foreign exchange, okay, which is likely to also have a stabilizing influence on the exchange rate. The view the central bank always takes is medium term, okay, it always takes a medium term view, all right, so that's why it did not increase the rate very substantially. Okay, because it's also concerned with, even though price stability is clearly its main objective, it's also concerned with maintaining reasonable economic growth, and actually our growth has been increasing very well over the last 2 years, and we expect that this year it'll go to close to 7%, and very likely next year will be 7%. So they don't want to also undermine economic growth too substantially. Okay, but at the same time, they don't want to let inflation get out of hand, because that's their main objective. The assumption we can work on is that by increasing the central bank rate from 8.5% to 10%, they're actually going mainly in that direction. That's the main policy instrument they're using to contain inflation. So we don't expect with that there'll be too much of a request for support from the IMF, okay, to deal with this particular situation. All right, but definitely because of the budget, okay, where there's quite a substantial gap, there's a budget deficit of 9% of GDP, they'll have to resort to borrowing, okay, from international financiers, okay, both multilateral lenders and also bilateral lenders. Okay, so the budget itself and the significant increase in expenditure in the budget is one factor that's likely to lead them to borrow. Not so much the situation with the exchange rate and with the issue of inflation, but certainly the budget is going to necessitate substantial increase in borrowing. I think the outlook generally is quite positive, because if you look at quite a number of the budgetary measures, they actually meant to spur growth. For example, we continue to invest a lot in infrastructure. In fact, infrastructure spending is one of the largest components of the budget. So we continue to invest a lot in the standard gauge railway, roads, okay, improvement of port facilities, energy. There was a lot of the budget was dedicated to upgrading geothermal energy facilities. So that's aimed at providing a firm foundation for growth. Okay, so improved infrastructure. Then there were a lot of allocations on security, as well. A lot of additional allocation on security aimed at restoring confidence so that our tourism numbers go up. So we expect that in the medium term to translate into higher tourist arrivals. Okay, so we expect some recovery of the tourist sector. All right. So we would say that in general we can expect the growth to be sustained. In the medium term, however, we need to be careful about the increased fiscal expansion that we've gone into, because you can say that fiscal policy in Kenya has gone through 3 stages. Okay, 2003 to 2007 was a stage of fiscal consolidation where we were trying to reduce the budget deficit and control debt. Okay, then 2008 to 2010 was a period of fiscal stimulus. We were trying to stimulate the economy after the post-election violence. And then since 2011 has been a period of fiscal expansion. So every year, basically every year government expenditure has gone up. So we need to be careful about that trend, because this could undermine some of the achievements of monetary policy. And in fact, it's very important to achieve coordination between monetary and fiscal policy, because the monetary policy tries to promote price stability and also to be pro-growth. So if you have fiscal policy that's borrowing more and more, then that will tend to basically exacerbate the impact on higher interest rates, okay, which could slow down growth. On the revenue side, we don't have too much room for maneuvering, okay, because our tax base is actually quite narrow. All right, in the sense that 40% of our taxes come from income tax, about 25% from VAT, and from a relatively narrow tax base where we're concentrating on large corporations fundamentally, and there's always a danger of overtaxing. So the government is always very careful, because already a large proportion of our budget comes from income tax. We don't want to increase that substantially so that disincentive effects come about. So there have been a number of revenue proposals. Some of them, of course, usual revenue proposals. For example, increasing taxes on beer and cigarettes. That's a usual source that the government relies on. So the government is expecting to raise substantially more from that source, because increased prices of beer and cigarettes kind of don't lead to a significant reduction in demand. So it's a very good source of additional revenue.